So, what's your view on the markets?
Our view on the markets at this beginning of spring are somehow mixed. Indeed, we had a very strong beginning of the year on European markets in particular, which was quite a surprise to us. We were not that buoyant at the beginning of the year. And as we are getting close to this time of the year when we start to have a better understanding of the impact of the winter in the US economy on the one hand, the strength of the US dollar on the other hand, and also of the slowing down of the global economy, we believe that we should be more cautious in the next few months. We are in the earnings season in the United States. So far, the earnings season has been reasonably encouraging, in particular in the financial sector. But there are some areas where we are not so comfortable in the short term. Furthermore, as far as Europe is concerned, the continent has largely benefited from the announcement of the quantitative easing and the first implementation of the purchases of the government bonds last month. But there remains in the short term two political uncertainties. Mm-hmm. One is the UK election that is due to May the 7th. And the second one is the never-ending Greek story, which its potential negative developments if eventually Greece decides either to go bankrupt or to leave the euro or a combination of the both. So all in all, we call for being cautious. Now, not all markets have to be underweighted. We have a positive view on Pacific equities and also on European equities, despite the uncertainties I was mentioning. We're more neutral and even underweighted on US equities that we believe to be too expensive in light of the recent market fundamentals. As far as bond markets are concerned, we like certain bonds, especially long-term sovereigns of good quality, which continue to play a very defensive role in investors' portfolios. And we also like very much long-term corporate bonds of good quality. We continue to have a constructive view on high-yield bonds and believe that investors should continue to own them and also take advantage of market corrections there to build up a bigger position on high yields.
You use a proprietary indicator in order to define and determine the potential performance of the various asset classes. How does it work exactly?
So we use indeed a market regime indicator to ascertain the market regimes in which we are at any given point in time. So it is a very useful indicator that is indeed used to ascertain risk conditions, volatility, but also investors' risk perception and risk aversion, which is an important pricing variable. Now, this indicator is one indicator among others that we use to manage our tactical asset allocation portfolio. It's not the only one. It's a very important one. It's one of the pillars, but it's not the only one. We have observed that over time, through the lens of this indicator, that we can draw certain general conclusions that hold reasonably well. Indeed, going back to the view that we have on the market environments, we have divided the market environments in normal market environments, low risk aversion, euphoria, and we have also on the other side of the risk perception spectrum, high risk aversion environments and crisis. In order to help us to ascertain in which environment we are using a combination of different financial variables: implied equity volatility, implied currency or implied volatility on currency, spreads on risky debt, because we believe that the global nature of the indicator is very useful when it comes to managing global multi-asset class portfolios, whether we are in Europe or in the US or in Asia Pacific. At the moment, the indicator is between normal and high risk aversion, which is also one of the reasons why we have this, I would say, more conservative stance and this cautious note on markets. We don't foresee the end of the world, but we believe that this higher level of risk aversion and the volatility we're observing in certain parts of the markets continues to be worrying or slightly worrying in the short term. I can say that we use this indicator very practically in certain of our strategies in order to manage the risk budget dynamically in response to the market condition changes. In a normal market environment, we will use a normal risk budget. So as we are right now on the higher end on normal and the lower end of high risk aversion, we have a lower than average risk budget. So how does it practically translate? To give you a sense, if the average risk budget is about 6%, right now we would not use 6% to manage the risk exposure of the portfolio, but we would use rather a fraction of that, typically something close to 3%, for example. I mean, it's an indication, but it's an interesting way. When market conditions are very positive for risky assets, we would probably have a risk exposure between, let's say, 8 and 10%.
And finally, as an expert, what would you suggest to investors in these days, in this month?
As an expert, thank you for that. We have a few principles. One is diversification. And even if right now yields are very low on certain part of the safer bonds, we do not recommend to sell these bonds. We recommend to keep them because they have a role to play to stabilize the risk-return profile of the portfolios. This is in particular very true when market conditions are very volatile. So diversification remains key, but it remains key across asset classes and also within asset classes. As far as global markets are concerned, we have observed that many clients, many investors, especially in Europe, they tend to have a domestic bias. And we believe that this domestic bias can be dangerous. So we recommend also to diversify globally. We also believe that advanced beta have a role to play in their portfolio. By advanced beta, we mean looking at the world beyond the lenses of the traditional capital asset pricing model, where the market cap weighted portfolio is the alpha and omega of all things. That's a great starting point, but we recommend to move away from that. And when it comes to equity investing, for example, we believe that low volatility equity strategies have an interesting role to play in investors' portfolios. As far as tactical considerations are concerned, I already mentioned some of the markets that we strongly favor, so I'm going to conclude on that again. Within equities, we favor Pacific equities and European equities, but we are underweighted on US equities and also emerging market equities. We are still underweighted on commodities, so we would not recommend to increase exposures there right now. Long-term government bonds, long-term corporate bonds of good quality should be a part of your portfolio, even if their yields are perceived to be low, because they have interesting characteristics in turbulent times, and yields there are certainly higher than the yields you can get on the shorter end of the curve. High yields as well has its role to play, and is an area that we are overweighting right now in our portfolios.
Thank you for your time.
You're very welcome. Thank you.